So let's talk about how to interpret stock market volatility. In this case, we need to understand, you know, uh, its role in economic cycles. So we need to start with number one here is expansion phase. In a typical economic cycle, you have the expansion phase. It is known as economic growth. So under the expansion phase, you have what are the inherent volatility characteristics for stocks, under the expansion phase of the economy. There's this low to moderate volatility. Stocks at this stage are not highly volatile as such. They maintain a kind of low to moderate level of volatility with upward momentum in stock prices, as economic growth drives earnings. There's that momentum, and the momentum investors, like this kind of environment. They they prefer, an economy in its expansion phase, in its growth phase. So, what's the interpretation? What's the corresponding relevant interpretation here? During growth periods, volatility may rise due to occasional corrections or investor reactions to external factors. But overall, markets tends to trend upwards as confidence in the economy grows. Usually, when consumers have confidence in the economy, they tend to invest the more in stocks, and the more investors pile into stocks, the more stock prices will increase. Then number two is the peak phase. The peak phase. After the expansion phase, you come across the peak phase. That's economic overheating. Economic overheating. So let's analyze the volatility characteristics as it relates to stocks in this particular stage of the economy. You have increased volatility, often triggered by inflation concern or interest rate hike. There's always, that increased volatility is triggered by maybe change in interest rates, or concern over impact of inflation. And so what is the interpretation here? At the peak of an economic cycle, market corrections are more frequent as investors react to rising inflation, tightening monetary policies or geopolitical events, signaling potential risks to the economy. So generally, you discover that the market will correct itself. At the expansion phase, most stocks are at a very high level. So at this particular phase, at the peak phase, correction starts to set in. Number three is the contraction phase. The contraction phase of the economy, popularly known as recession, economic recession. So technically, it is the contraction phase. So what actually, are the volatility characteristics for stocks during a recession or the contraction phase of the economy? So you have high volatility, with sharp market declines, driven by negative economic data. You have rising unemployment, you have shrinking gross domestic products, GDP. So all these factors will combine to drive the price of stocks down. And what is the interpretation here? So during a recession, volatility tends to spike as investors fear economic decline. Markets often experience significant drops, but they also provide opportunities for value investing in distressed assets. Distressed investors, they favor this kind of environment. to make a killing, to obtain higher returns. Number 4 is the trough phase or economic recovery. There's the growth phase, there's the peak phase, there's recession, is very popular, recession, and then followed by recovery. No matter how long a recession lasts, it will always recover. It doesn't last forever. Eventually, the economy will recover. So, what's the volatility characteristics as it relates to stocks here? There's that initial high volatility followed by stabilization as economic recovers. There will be stabilization as the economy recovers. As what's the interpretation here? In the early stages of recovery, market may remain volatile as investor sentiment fluctuates between optimism and caution. They are cautiously optimistic. They are cautiously optimistic. So as economic indicators improve, volatility tends to decrease and stock prices begins to recover. That's it. It begins to recover. Now, what happened during the housing bubble, the global financial crisis? The economy recovered, and that recovery lasted for more than 10 years. It lasted for more than 10 years. So understanding the relationship between volatility and economic cycles help investors to anticipate potential risk and opportunities tied to the phases of economic growth and contraction. So each phase has its peculiar characteristics as it relates to volatility, and your ability to interpret the behavior of stocks at each stage will really help you as an investor. To help you so much to be able to know when to invest, where to invest, where not to invest, and when not to invest, depending on the peculiar phase of the economy at that particular point in time. So you need to be able to interpret this market volatility. Is very important as an investor.